Welcome everyone. It's Monday the 3rd of August 2015. I hope you've all had a few great trading months. It's my first time back on FX Street. I've been away for a few weeks now. I think last time I was on was maybe back in June or something like that. So I hope you've all had a good time trading and been staying safe and minding your exposure on the markets. If it's the first time you're attending one of my webinar sessions, just to give you a breakdown of the objective of the session, which is we just want to highlight the key trends and triggers that will allow us to establish directional bias. I use trend walls a lot, I use support resistance a lot, and as far as trading is concerned, it's all about having a trigger condition that will allow you to get a sharp entry. And if you can get a sharp entry which has good risk definition, and what that essentially means is when you're taking that trade, you're not risking a heck of a lot as far as pips are concerned in order to get involved. What it will mean is that when you do bank that position, you're able to pull out an R&R trade, a trade which gives you good risk to reward ratio. I've been trading for 10 years plus now, and a lot of people who were around when I started trading first are just simply not around anymore. And the principal reason for that is, these aren't people who have gone away and they're sailing around the Caribbean in their yachts now, having become filthy rich as a result of trading Forex, but more likely they've gone broke. And the difference between the people who survived and the people who didn't, the people who fell by the wayside, to my knowledge and experience, has always been the risk and reward ratio. Simply put, 1-on-1 will never be enough, 1-to-2 will never be enough, and even 1-to-3 is not good enough. If you can take trades where you're pulling at 1-to-5, 1-to-10, then we're really talking. And so what I found a long time ago was, I'm not always able to control, although I do look for substantial targets in my trade. I'm not always able to control the target. But what I am able to control, and using technical analysis and various charting techniques, is the place where I take my entry. And I try to design that to give me the least amount of risk. And therefore, what it would mean is that I'd be able to pull out the most substantial risk and reward ratio from any given trade, right? So that's the objective that we have. Normally, as we enter into the month of July, we do usually find that the price starts heading sideways, and my trading is mostly about momentum and looking for momentum to follow through, right? So I'm a momentum trader, and I like to see the price falling so that I can be selling it, and then I'd like to see that momentum following through. If the price is rallying, I would look for an opportunity to buy it, and then I'd want the price to follow through. Usually as we head into the month of July, and as well early August, we do quite often find that the price will start ranging a little bit and give a little bit of sideways movements. You get a lot of snapbacks, so the price will rally, turn, and start falling, or she'll fall, turn, and start rallying just at the point at which you would be expecting short, or the point at which you would be expecting to go long. So particularly during the month of July, and usually as we head into the middle of August, things start normalizing a little bit. But what I try to do is to look for more substantial triggers, and that way I don't fall prey to those snapbacks in price. So if I'm looking short an instrument, she really has to be falling before I'm shorting it, and if I'm looking to buy it, she really has to be rallying in order for that instrument to be bought. So just a general kind of word of caution there. We are in a light trading season, and usually I find that as we head towards the middle of August, the market starts snapping back towards its usual rhythm. So just mind your exposure a little bit these first couple of weeks, but as we head out of August, we expect for the normal market rhythm to resume. All right. First up this morning is the Euro USD, and one of the things I've been doing over the last few weeks is designing triggers which are as likely to keep me out of a trade as they are in order to place me in a trade. As far as the Euro USD is concerned, the support wall which I'm interested in is the one which is taken something like this. Right, so we're going to connect a wall which we're taking from the low. That low is from the 23rd of April, and then we're taking this resistance which is from the 20th of July, and you can see we've got a nice support resistance wall there. So we had support, it was resistance, it's been support, and support again. And the general kind of expectation that I have for the Euro USD is that I don't think that the downtrend is over on the Euro USD. I know a lot of people have started to believe that the instrument has bottomed at 105. Rather, what we're looking at is that she fell for a substantial period of time. And in fact, over the course of the last year, she fell a heck of a lot, right? So, I mean, if we're looking at from the highs down 3.5, 4,000 odd pips, that's a very, very substantial fall there for any instrument. And now what we're looking at actually is a little bit of sideways movement. You're getting that flat. But what she's clearly not doing yet, and even though she rallied from the lows there, just sub 105, all the way up to the 114 price handle, what she's clearly not doing is being in an uptrend. Rather, what we've seen is that she fell, and after the fall, she's gone flat. And ordinarily, if she's gone flat, it's not unusual once this sideways consolidation is completed that we're going to get a resumption of the preceding bearish momentum in this instrument. And so until I see price action that demonstrates otherwise, until I start seeing support structures being established on the instrument, actually, even if she's rallying, those rallies I would consider corrective until we start seeing actual support structures being established on the instrument. Right now, in the wider time frame, we're still looking at resistance structures, and therefore the bear trend actually is intact. Now, from a strategic point of view, although we have a bear trend on the Euro USD and that's intact and all right, she's gone flat, and she's been flat for the last couple of months now. Since February, March, that range begins in. Do you want to be selling rallies, or would you be rather selling as the price is collapsing? And so, from a strategic point of view, what I've chosen to do is to sell as the price collapses, rather than to be looking to sell rallies. Just in case the bulls are right about this, because once she goes flat, although I give precedence to the continuation of the preceding trend, it's just as likely that price can go flat and then give substantial reversal of trend out of that. But in any case, what I'm doing is I'm designing short triggers, and I'm saying, okay, what is it that would allow me to initiate a short trade on the Euro USD? Right now, what I have is a lower support wall, and it's been taken from the points which are being described here. So we have support. What we have is support, resistance, support. And my expectation is that so long as the price actually remains above that, it's not unreasonable to look for further rallies to the upside. But what I would like to see here is a breach of that wall. And if that wall is breached, H1, H4 closes below it, I would very much suspect that the price would follow through to the downside, and either going to follow through to the downside, or you can chase that on H1, H4 closes below the wall, or you get a pullback, and it is a support resistance wall. I think that's something which has been clearly demonstrated. On the underside, you would expect the price to act as resistance, and certainly you'll get a reaction on the underside of that wall. So I have a short trigger here for the Euro USD. It's still, the price is still going to have to fall a reasonable amount in order to allow that trade to trigger. She still needs to drop another 100 odd pips, but if it happens, I think that selling on the underside of that wall, it will give you quite a sharp entry. If you did it, you wouldn't have to risk more than 20 odd pips in order to get involved in that trade. And so then even if she moves 40, 50, 60 pips in your favor, you've pulled out quite a decent R&R out of the Euro USD. It's quite interesting to note that she hit that low back in March, and considering the nature and the strength of the fall in the euro, I really wouldn't be surprised if at some point we had a retest of that 105 price handle. I think it would be really unusual for there to be a wave reversal, or for there to be a trend reversal, which started with a structure like this on a H4 time frame. Right, that's what I'm finding unusual. If it was going to double bottom, we'd have to do it on a daily time frame in order to get a significant or meaningful trend reversal, right? So, if you guys are saying, hey, Will, are you saying that, that 900 pip rally is not significant or meaningful? It was corrective in nature, right? It's 900 pips, corrective in nature. What we're talking about is, would we find that there's a beginning of an uptrend here on the back of the H4 structure that we had, and just a single test of 105? And what I'm saying is I'd find that unusual. And therefore, my expectation remains that even if she rallies, and even if she rallies above the 15 price handle, we will get a resumption of bearish price movement on Euro USD. And I can't rule out at this stage another test of the 105 price handle. But in any case, I have a trigger in place, and I'll only take the trade if the trigger is there. The trigger should give me a fairly well-defined short entry on this particular instrument. It's also possible, if you are bullish on Euro USD right now and just using the near-term structure, you could mark up a trend wall at something like this, all right? And just as the lower trend wall would give you a short trigger, that upper wall, a breakout would give you a trigger for long trades. But as I mentioned, my preference would be to be short on the Euro USD as opposed to going long on a breach of that upper wall. That's as it stands right now. All right, let's look at Swissy before we look at pound. So it's the dollar Swiss, and on the dollar Swiss, what you ought to be marking here is a support structure. That support structure goes something like this. So it's just taking the lows. That low is from the 15th of July. All right, so it's and there's a cluster support there where we just take it through the lows, and this is something which I'm finding particularly interesting right now from a price action point of view. The reason for that is that it's quite a clean support wall, right? So support, and last week we had price spike down to somewhere near that support wall, right? So you can see that she was just shy of the support wall, and that is something I find particularly interesting. The reason it's interesting is that I have rules that I use in order to construct my support and resistance walls, right? So there are about 9 rules which I use, and uh, and as long as and what that does is it allows me to draw a wall consistently. Every time I draw a wall, it's been drawn according to a particular rule, and so every time I'm drawing the wall, this support wall that I've drawn here is exactly the same as a support wall drawn according to the same rule, which I've done 100 times, which I've drawn 100 times. And what I find is that the price action behavior around these walls tends to be fairly consistent, and it's understanding the way that price behaves or how price behaves around the areas that I mark that allows me to develop price expectations. So, whether the price is going to be pushing higher, whether she's going to be pushing lower, whether there should be an expectation for a wall to hold, whether there should be an expectation for a wall to be breached. Whereas if you're randomly drawing lines, they're meaningless because you'll never be able to decipher the price behavior or how price behaves around that particular structure. So here what we saw was the price drop, and she found support just above the wall. She didn't go and hit it. And so I've seen this happen before, and usually when something like this happens, that's indicating that the buying was very strong near the wall. But the next time price comes to that wall, I would very much suspect that we're going to get a breach. And I see that happen fairly often. I see that happen more often than it doesn't, particularly when we have a structure like this, right? So I'm not saying that the price is going to fall. What I'm saying is that so long as the price is above the support wall, technically, from a structural point of view, and this is really important, it's the market structure here. There was support being established. Your default position would be long. But if I see the support wall here being breached, I think that would become a good trigger for a short trade. And I would rather take the short on USD CHF on a breach of the support wall and its corresponding backtest than to be going long on Euro USD on the breach of that upper resistance wall. All right, so the plan in effect is short Euro USD on the breach of the lower support wall, and generally speaking, if the Euro USD is rallying, you can expect USD CHF to be falling. But if the dollar Swiss falls, I would sell the back test of the support wall here, looking for a deeper move to the downside on the dollar Swiss, as opposed to trying to buy the Euro USD. Hope that idea kind of makes sense, right? But that would be my preference as far as technical triggers is concerned. I have more reason for believing that a breach of this support wall would give a deeper correction than I have for believing that the breach of the upper wall would give a necessarily a strong pip rally to the upside on Euro USD. All right, GBP USD. This is going to be quite an important one this week, considering the amount of pound-related data coming out. It is a big week for data this week. It's all the central bank releases, but on Thursday we have the Bank of England with their rate and statement, and as well there is the inflation report. And following the inflation report, there is a panel of the Bank of England Monetary Policy Committee headed by Carney giving a press conference. And last year Carney started talking up the pound like it's just crazy talking up the pound, and he talked up the pound, to the tune of thousands of pips, right? So 1,700 odd pips he talked her up. And then we had one of the Bank of England economists, I don't remember who it was now, called Ben or someone, I don't know, right? But came out and said, hey, these interest rate rises that we've been telling you are going to happen, and they could happen soon, and they could happen as soon as this year, before the end of 2014. Actually, what we mean is the end of 2015, and then the pound just collapsed, and that rally of 1,800 odd pips, she just fell, and we're back to where we started in the 50s. Now, again, a few weeks ago, Carney started making noises, and he said, "Hey, it's going to happen this year, and it's going to happen it's going to happen sooner than you think it's going to happen," and that caused some spikes in the pound crosses, and more in the crosses than actually in the pound dollar itself. But the general expectation is there again, that a rate rise is coming. Now, everyone's going to be eyeing the rate statement, which is not expected to change this time. And as well, they're going to be eyeing the inflation report and the press conference. But keep an eye on the voting pattern. All right, keep an eye on the voting pattern at the MPC. So for a little while, toward the end of last year, we did have that thing where it was 009, and so there was 9 people against raising interest rate, and it went to 09, and then it went back to 009 this year. So if that rate rise is going to happen, you need to see 209. You need to see 207, and then 306, and then you need to see 405, and then you need to see 504. And so if that voting pattern does not show a change this time round, then I think that the market will be fairly disappointed, especially considering that Kanye started talking up the pound again, and he's put a rate rise pretty fairly squarely back on the agenda, right? So keep an eye on that voting pattern, and I think that rate statement aside, and inflation report aside, and press conference aside, that voting pattern is the number, or is the data release which the market will probably be paying most attention to. So as far as this particular instrument is concerned, we like the idea of upside, and you can't rule out further upside on GBP USD certainly, but there are 2 areas that you ought to be marking. All right, the first is our support wall here. So we've just taken it from those lows in early July, and if you want to cheat on this, you can probably connect it. You can probably connect it a little bit higher up there, but I prefer just going exactly against the lows in July in this particular instance. And so, as far as the rules are concerned, it's the same rules as the one that we applied on the Euro USD. That is our support wall, and I think that if the market is disappointed by the voting pattern, we may well see some element of corrective price action on the GBP USD, right? But you're going to need your H1, H4 breaches of that lower support wall in order to act as confirmation of that. And just bear in mind that in origin, a support wall is a support wall, right? So, if you're getting bullish H1, bullish H4 bars off of that support wall, that in itself could become a trigger for a long trade on the instrument. But my preference as far as the lower support wall is concerned is to be shorting the breach, right? That's my preference as far as the lower support wall is concerned. To the upside, the other area of interest is right here. So we have this zone here pushing up towards the 57 price handle, and this area is relevant for a number of reasons. Not only is it kind of support and resistance, but from a flow perspective, it also represents our quarterly opening price. So last month opened at this kind of 56.80, 56.90 price area. So right now, the quarterly flows, the quarterly dynamic is still bearish on the instrument. But if it happens that we get a breach of that, and look, there are two ways that this could happen, right? So, either she makes a shallow breach and a minor pullback, and then she follows through to the upside, or she makes a strong breach and then consolidates, maybe in the upper 57s, right? Either way, if we have a shallow breach and a pullback, we'll attempt to buy it. And if she makes a strong breach and then a consolidation, we'll attempt to buy the consolidation, then looking for momentum to follow through to the upside here on GBP USD. So she's very much being talked up right now, and we expect, there's a modus operandi here as far as the Bank of England is concerned, and as far as Carney's statements are concerned. He opens his mouth and the pound starts rallying. That's how it's been working these last couple of months. And he went quiet and it started falling. All right, so he went quiet just before the elections and it started falling, and then after the election he was back, right, with a vengeance almost. So I think Wednesday is going to be the big day for the pound dollar, for the pound crosses this week anyway. Wednesday should be the big day. Just be alert around that statement in particular, and if these breaches occur around about that time, I think they will be fairly significant as far as the pound dollar is concerned. Okay, let's take a look at the Aussie dollar, and we're going to come back to the pound in a moment. We're going to look at pound Canadian, pound Aussie. With quite a lot of analysis, in fact, on the pound process, so it's all worth taking into consideration. But the Aussie dollar first. All right, so is the Aussie dollar? She's down, almost 900 pips or something on the year. It's down 900 pips on the year, and we're here in the lower 70s now. Structurally, as far as the instrument is concerned, there's no kind of denying the most recent bearish momentum, and we're still seeing that bearish momentum follow through, and no sign of any significant reversal yet. But I do like the idea of a potential for a more significant corrective rally on the Aussie dollar. And so I'm marking a support wall, and it's just taken from the last consolidation area on the left-hand side. So we're on a H4 time frame here. And once you've marked that wall, you can see quite a consistent price behavior here on the Aussie dollar, right? So what we're looking at is support, 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 and support and support. And I guess by this time you're not really surprised anymore that once the price has breached that, you're finding that this support wall is starting to act as resistance. As far as my technical pattern play is concerned, so long as she's below that wall, technically she's a short. So you should not really be doing anything other than trying to sell the Aussie dollar at this stage. And the only reason you need in order to be selling it is, hey, there's a resistance wall there. She's below that resistance, therefore I'm short, and that is pretty much in line with the overall trend on this particular pair. So, why can't there be further downside? And I'm quite happy with that thinking, although my preference actually for the Aussie dollar is if I see the price breaking back up. So she might still go and she might still fall a little bit further, but I wouldn't want her to be breaking down significantly from this consolidation phase, but a little bit more consolidation and a break up through that And at that stage, I'd be quite happy either to chase the break to the upside, so H1, H4 bars to the upside, or a tap back. And if that happens, I would expect quite a significant rally to the upside. And I do believe, based on this being a H1, H4 structure, that we might even be looking at the upper 70s. So a push towards 76, 77, maybe even 79 price handle on the Aussie dollar, and that could give quite a significant, for now, I'd call it a corrective rally to the upside, right? So Aussie dollar, I think there's some upside here, but it's a pattern play, and the trigger is a break above, is a throwback back above our support resistance wall. So the support resistance wall has been quite clearly defined, right? We have our SR wall that's been quite clearly defined. The price is reacting around it. Default position would be short, but my preference is for a pattern play, and I'd be looking for the price to break back up through that resistance wall. If that happens, then that is my long trigger, and I'd be quite happy to chase H1, H4 bullish bars once the price is on above that particular wall, right? So that's the Aussie dollar, and you're going to see in a moment why it's important to have this perspective on the Aussie dollar as we come to some of the crosses, but just kind of bear that all in mind as far as the Aussie dollar is concerned. All right, Canadian, right? So first up, Euro Canadian. There was a surprise cut by the Bank of Canada last month. No one was really expecting that, although the price was quite happy to forerun the event in any case. And it's starting to look as though there is still a lot more weakness in the Canadian to come. So what I wanted to do was to define structural bullish bias and structural bearish bias on the Canadian crosses in particular. So I'm just going to start with the Euro Canadian. Euro Canadian, there is a lower support wall. You should be able to mark that quite easily. I guess something like this. So we're just taking the lows here. Okay, so we've just taken the lows there, and so we have a support wall. We can see 1, 2, 3, 4, several reactions off of that support wall. And I'd say, as far as the bull bias is concerned, so long as the price remains above the support wall, then technically the bulls remain very squarely in charge of the instrument. Now, we also have an area here where we have support turning resistance. All right, so that's coming in around about the 43.40 price handle. And so what I'm saying is that, Euro Canadian is long, and she's long so long as we're above 43.40. Pretty much from the word go, she broke higher. She broke up pretty much from the word go. You can see that breakout candle there from when the market opened. And so what I'd be saying is, there's no harm in buying a bullish candle, and it doesn't matter what time frame that bullish candle is on. But if you bought now the Euro Canadian and you put your stop just below the last bull candle, it's not going to cost you more than 20 pips in order to find out. But she does look as though she wants to follow through to the upside, and from a structural point of view, I don't want to be risking 43.40. That would mean a 100 pip stop, but I don't mind risking the size of an hourly bar just to see if she will give further follow through, and then following the momentum of the week. So it does look as though there is more upside on this, where we are actually going to, if we take the trade, place the stop in harm's way, i.e. our stop is going to be above where the support is and above where a bearish bias might be established from, and therefore a bullish bias invalidated. But it looks like, it looks like it would be quite fair and reasonable to just attempt to follow bullish momentum on H1, H4 timeframes on the Euro Canadian. So a general outlook and a general forecast there really on the Euro USD, but it's all about the support wall, and if it's not about the support wall, then it is about our support resistance structure, which comes in at 143.40, right? That's where it's about on the Euro Canadian, and as long as she's above that block, as long as she's above the wall, then technically she is long. A breach of the lower support wall, and that could well give you a short trigger on this here instrument. Okay, pound Canadian. Pound Canadian, right? So if I'd been doing this last week, you would have heard me talking about upside on pound Canadian. So that's what we published in our trade plans last week. But there is a channel wall on pound Canadian, and there are a number of points on the left-hand side that you can take it from. I've taken it quite crudely here. My recommendation on, in fact, if you go here, my recommendation on the pound Canadian is long, and I think that what we've got is a support structure which has been now established here, right? So we have a support structure that's been established at 201, 202 price handle, and any kind of pullback to our channel wall. So we had a channel wall that's been breached, and there's a channel wall which is a little bit higher. In fact, it goes something like that. But any kind of pullback to the channel wall, I think that's going to become an opportunity to buy the pound Canadian. She's likely to push much higher, certainly towards the 209 price handle. That's the target to the upside on the pound Canadian. Now, there is one more wall which you need to mark, and I'm just going to remove that one. There's one more wall which you need to mark here, which will give you your upside target on the pound Canadian, and as well terminal expiry on this instrument. All right, so we're taking the lows here from the 7th of May. These are May lows, early May lows, and if you just take the highs, so that is the high from the 19th of June, and then we have our highs here from earlier on in the month. So maybe if you just take it from those, the expectation on pound Canadian, I'm just going to compress the chart a little bit. The expectation on the pound Canadian is that she's going to go for a third strike on the underside of this particular wall. And once we've got that third strike on the underside of that wall, that is where the bull trend will expire on this instrument, and after that you may well get a significant, I'm just messing up my lines here, one moment. I've just drawn a secondary wall as well, maybe needed. All right, so the expectation is that she will continue to rally. So she could pull back, but she will continue to rally until she goes and strikes the underside of the wall that I've got marked here. Right now, this is a setup. It doesn't occur too often, but when it does occur, usually it spells money, and it's going to be the third strike on the underside. So there's the first one. Here is the second one. That third strike on the underside, usually it is terminal. All right. So what will happen is the price will go and hit that, and she might go flat off of it, but at whatever price she strikes, we expect that to be terminal, and then to get a very deep correction off of that. And when she corrects off of that, she usually corrects down to the area of the first strike. And so whatever price that is at, when that happens, that will give us a downside target of 195. All right. So it could be a big trade. It could be a very substantial trade which is setting up there. So in the near term, we expect the pound Canadian to rally. We expect pound Canadian higher. But once she has gone and struck that underside the third time, and there's a little bit of a extension here. You can see I've kind of got that marked. So there was a resistance there from early June, around about the 5th of June, that I've taken that from. But once she goes and hits the underside of that, it'll be the end to it'll be the end of the bullish play on the pound Canadian, and then I'd be actually sitting in wait, looking short the underside of that, and I'd be quite happy to even fade that and to play that quite aggressively. But pound Canadian is one that I've been actively monitoring for a long, long time and trading for quite a while now. And that is the expectation now. So even if she pulls back, so long as she stays above the 201, 202 price handle, structurally, that is support. And we would expect that if she does a pullback, I wouldn't be expecting actually a pullback as deep as that. And our expectation is that there will be a rally which will go and strike the underside. It gives us a upside target for buying. Once she's hit that, you do not want to be holding longs anymore. Certainly don't be going long as she's hitting it. We expect quite a strong resistance reaction off of it. And you know what? There are enough calendar events even in this week to allow that to happen. So we've got the Bank of England, on Thursday, but we've got NFP on Friday too, right? So there are enough events there which could give the volatility that could allow that to potentially take place. So, we expect upside, and after the upside, then we will imagine a downside, but we'd like to see her hit the underside of that wall. If she's hitting the underside of that wall, I may or may not be long, or may not have long exposure on the pound Canadian. But if she's hitting the underside of my walls, I will definitely have short exposure to the pound Canadian if indeed it happens that comes to pass. So we'll see how that plays out over the course. Also worth considering it's also worth considering the pound Australian. We were looking at the Aussie dollar a little bit earlier on. We have a support structure on the Aussie dollar, right? So if you want support structure, you're looking at something like this. All right, so there's the support structure that extends down to around about the 212 price handle, right? So it's a little bit of a basket play here, right? It's a little bit of a basket play here, and I'll explain why, right? So remember that Euro USD and dollar Swiss that we looked at, and I was saying, well, I don't want to be buying Euro USD, but I'm quite happy selling the USD CHF because the short trigger for USD CHF is cleaner. There's a cleaner interpretation than the long trigger for the Euro USD. All right, so I have an expectation with the Aussie dollar that we're going to get a throwback above the resistance wall. And if that happens, you can be fairly guaranteed that there are going to be a lot of buyers jumping on the back of that, and I'll be one of them, right? So we're going to be looking for Aussie dollar higher. If we're looking for Aussie dollar higher and we're looking for pound Canadian higher. All right, we're looking for pound Canadian high. So, uh, long exposure to the pound, long exposure to the Aussie dollar. You can't ever really get both. All right, so uh, this makes it a basket play, but it's a basket play with triggers, and uh, the trigger condition is such that, yeah, if the Aussie is rallying and I've got exposure to pound Canadian long, but that trade is failing, then a breach of 212 gives me a short trigger on GBP AUD. Right? See how that's going to work out? Good. So GBP AUD, it's all a question of where that exposure ends up getting taken as far as the trades are concerned. But the trigger conditions are significantly apart from price in order to make their breach meaningful. Right? So, if pound Canadian is going to be failing and she's not pushing up for a third strike to the underside of the wall, then the likelihood is that the pound Aussie is going to fail also. A breach of support on pound Aussie gives me a short trade, and it allows me to capitalize on a failure on the pound crosses generally across the board, right? So there's a reason why the pound Aussie is under consideration, and that's the reason, right? So it's 212. It's a support structure there. Allows for very easy interpretation, depending on whichever side of that block the price is sitting on. So currently, it would be default long on the pound Aussie, right? That would be the default position, but I would be interested in a short if she happened to breach that 212 price handle, and I'd be looking for something potentially on a retest. Okay, so that's the pound Aussie covered. All right, last set up is the Kiwi dollar and the Euro NZD. So the Kiwi dollar, we gave a recommendation to our subscribers last week just to mark this single block on the hourly. It's been taken from the left-hand side. You can see where that's been taken from. This was a resistance cluster which formed in the middle of July, and the price came. We tested it. It was resistance. And once the price breached it, it's not unusual to expect that that same area would start acting as support. Last week, the price fell into it, and you can see that she rallied, 100 pips plus, bang out of it, right? So what I'm saying with the NZD USD is similar kind of view to the Aussie dollar, right? I'm expecting a more significant corrective move in the Kiwi dollar. I think that it is reasonable to expect the Kiwi dollar a little bit higher than where she is right now. She's exceeded the Reserve Bank of New Zealand's expectation or valuation, right? So, some months back, it was last year, the Reserve Bank said that they thought that a reasonable valuation for the Kiwi dollar was somewhere in the 60s, maybe around the 66 price handle, and she's gone and met their valuation. And so what that means is that they don't need to intervene anymore. More recently, I had a good friend of mine who's been following the central banks, and he was telling me that one of their speakers, I don't know if he mentioned if it was the governor or not, but he said that they issued a statement saying that they thought the Kiwi had depreciated a lot faster than at a lot faster rate than they had expected it to, right? So they're not on the short side of the Kiwi anymore, and so it's not unreasonable now to expect some rallies and to expect corrective moves to the upside, or more decent corrective moves to the upside on this particular instrument. So just toward that end, we have this here support resistance block. It's a local structure. And what I'm saying is that so long as the price remains above that, then we can expect some strength in the Kiwi dollar, but it does very much depend on the price remaining above that block. So it's worth having that mark. If that block is being breached to the downside, then maybe it opens up the door to the lower 60s, and that's something we will have to investigate the price action if in fact something like that does transpire. But so long as she remains above this block, we can be optimistic about a higher valuation for the Kiwi dollar itself. Now, the reason that the Kiwi is important is that a few weeks back, I started making recommendations to our subscribers to be looking for shorting opportunities on the Euro NZD. There are several reasons, and there are several walls that you could mark from the left-hand side that might have you believing that perhaps we could see a deeper correction in this particular instrument. And so I've been quite happy to place shorts on the Euro NZD pretty much throughout the whole of the month of July. Although now I'm a little bit more cautious. She's stalled here a long time, and now what I want to be doing is I'm not selling rallies anymore on Euro NZD, but I do expect for a deep move to the downside on this instrument, right? That's something that I'm expecting. And so the level which is important for me, or the area that's important for me, is, and you can mark this in several different ways here, but you can mark some support walls here on Euro NZD. And if we see the price falling, and particularly if we see her pushing below, below 65, 64.40, that kind of area, we get a breach of our support walls here on the instrument. Then there's no reason why she can't make a move back towards the 52 price handle, right? So lower 50s. From where it is right now, we're talking almost 1,400 pips to the downside, right? We're talking almost, yeah, that's right. Okay, so 1,400 pips to the downside on Euro NZD. That's the kind of general expectation. But the stall has got me a little bit here. And, sometimes you have that thing where you isolate a level and you get involved a little bit too early. So I've had that with the Euro NZD. I've sold this now not quite a dozen times, but I guess we're approaching that. Maybe 7 or 8 times I've sold it, and then after a couple of hundred pips, I take something off the table. I hold the balance of the position with a stop probably just above entry or near break even, and the price rallies again, stops out the position. So now the strategy with the Euro NZD is that if she is going to fall from here, then I want her to fall first. So I'm selling on the back of a bearish day rather than attempting to sell the rally. There is a support structure there. It's clean. It's just so clean. It's very easily visible even to the most novice analyst. And so long as she's remaining above that, technically it's bullish. But if I get a breakdown, then I have a target to the downside. There's a debt, and the instrument has to pay it. And if she breaches that support, I think it will open up it'll open up the lower 50s. All right, that is the key with understanding Euro NZD. All right, so might make a little bit of sense then why I have a preference for a breach of the lower support wall, and why I think that 105 could be revisited on the Euro USD. For the Euro NZD to work out, we need Euro weakness, and we need the Kiwi to be able to hold her on, right? So it doesn't matter if the Kiwi is flat and the Euro is going weak, right? Or if the euro is flat and the Kiwi is rallying. I'm happy with either scenario because both of those would mean the euro NZD breaking down. And if the euro NZD is breaking down, I think that there is going to be a very, very good trade there on this particular instrument. There'll be a lot of pips to collect on the way. And certainly once she starts breaking down, you can get involved. You can get involved in selling any rally. So, once she's gone sub 60 and then she rallies back up through the 60s towards 62, 63, you'd sell it again, and she'd fall and she'd rally and you'd sell it again, because at that point it would be reasonable to believe that there is a rounding structure, which there's going to be a rounding structure which is completed here. You're kind of looking at something like that. And what you really need now is for her to start making lower lows and lower highs, and then she can really start breaking down. All right. So I'm looking for that rounding, and I'm looking for that rounding to complete. Once that happens, then there is something there to play for at that point on this particular instrument. Okay, all right, that's the Euro NZD. The GBP NZD, I'm not keen on positioning on GBP NZD. I know you can see it there on my chart, right? I'm not overly keen on positioning on this. The fundamental dynamics on the pound and the euro are looking very different now, right? So euro, we do effectively remain in negative swap territory on the euro, and with the pound, it looks as though that is about to get wider, right? So if it happens that there is a rate rise, and we're not expecting huge rate rises, right? The kind of general expectation that they've built up is they might do 25 basis points and then wait 6 months to evaluate it. And they have said in the past, and there's a question there about the Fed as well. We'll come to that in a moment. But the Bank of England and the Fed, they've said, hey, there is going to be a rate rise, but don't think that we're going back to how it used to be in the olden days, where you have 2%, 3%, 3.5% interest rate. It's going to be very slow. It's going to be very gradual. And so what that means is, they might do 25 basis points, and then they might wait 6 months monitoring the data just to make sure that they haven't impacted the growth in the economy too much. And actually, it's a bit of a rigged game. They're more concerned about valuations in the stock market than they are in real growth in the real economy. But so GBP NZD, I'm a little bit cautious, because if you get that strength in the pound, you can still get these kind of divergent rallies in GBP NZD. And if you want a good example of that, you want to take a look at GBP JPY. So if we go GBP JPY, GBP JPY, this is GBP JPY. I'm just going to go on the H4 time frame there. Okay, zoom out a little bit. We get January interview. Ooh, we've almost got January interview here. Maybe if I take the scrolls off. And we also want to take a look at Euro JPY. Now, I'm running over time here. I just want to check with the FX Street admin if that's okay. there's not another webinar scheduled right after me or something. All right, so we'll keep going until they cut us off. That's fine. Yeah. All right. Perfect. So we've got Euro JPY. Here's Euro JPY chart. So again, we're just going to go to the H4 chart and scrunch out and take off the scrolls. Press it a little bit. So all right. Just ignore the spiky bars. I like looking at raw data sometimes. This is a raw feed. Sometimes they can give you clues about the direction that the price might head in. All right, so that level there that I've marked is pretty much from the, where are we looking at? We're looking at the 1st of January here. I guess this is where the market opened at the beginning of the year, and pretty much from the word go, she collapsed to the tune of about 2,000 odd pips, and she hasn't recovered yet. Okay, she hasn't recovered yet. So Euro JPY is down 1,000 pips on the year. If we had to describe what she's done this year, she's down 1,000 pips on the year. If we look at GBP JPY, on the other hand, at the beginning of the year, she did weaken. Right, so at the beginning of the year, she did weaken, and she went down about 1,000 pips. But right now, we are up 700-800 pips on the year. So about 700 pips on the year. Okay, so that tells you something about the divergent tracks that the pound and the euro are on right now. Okay, if you like arbitrage, then this idea should excite you a little bit, right? Because eventually they will catch up with each other. So eventually, when the pound rallies, the euro, when the pound yen rallies, what it means is that the euro yen will rally too. Or maybe what we might see is the pound yen dropping and the euro yen holding its own until they come back into some kind of equilibrium. But right now, there is a little bit of an imbalance against the yen crosses. If you're looking at Euro JPY and GBP JPY, ordinarily, what tends to happen is that if Euro JPY is hitting new highs, then GBP JPY tends to be hitting them also. And if GBP JPY is hitting lows, then Euro JPY tends to be hitting them also. So you can see that disparity, you can see that divergence. And I would be inclined towards believing in a greater correction in GBP JPY, but it's not something that I'm prepared to speculate on. All right, but it just kind of demonstrates the idea. You can get this kind of divergence, and so what we're seeing happening with Euro NZD and GBP NZD, although they're both at near relative highs, it doesn't necessarily mean that they would correct in the same way. All right, so Euro NZD, I can see substantial downside. GBP NZD, to get downside on this, you really need strength on the Kiwi, right? And it will be Kiwi strength that will bring GBP NZD down. And even if that happens, there is the danger that you have George Clooney starting to talk it up, right? So that's why I'm kind of cautioning or shying away from this particular instrument right now, as far as the trade is concerned. I would rather have uh, Euro NZD short when she's falling than looking to be shorting GBP NZD just for fear of snapback on the instrument, and I think that that could be a little bit more severe. Um, okay, as far as the Fed is concerned, do I think that the Fed will raise interest rates before the Bank of England? I think that uh, I, I think the Fed is very much on the cards now, and the general expectation is that it will be a September rate rise. Although at the last congressional hearing, Yellen was actually asked about it, and the question was actually quite clear. He said, "Look, is it going to be at one of those? Is it going to be at a FOMC with a press conference, or is it going to be at a FOMC where there isn't a press conference? Because you would expect a press conference following such a decision, right?" She's a sharp woman, and her response was equally sharp. She said, "Well, if it happened at a FOMC where we wouldn't have a press conference, we would organize a press conference for that." So she wanted to leave the options open, but generally speaking, the expectation is that it would be a September rise. It would be politically unacceptable for a rise to happen in November or December, right? So I think that's just a cultural issue. Uh, that's not, it's like leading up to Christmas. That doesn't always work. All right. So the FOMC is on the cards for September, and I think October would be the latest it could happen if it was going to happen this year. Otherwise, if it ends up going into next year, you are looking at probably February or something like that. It wouldn't be January. People have too much credit card debt that time, but it would be February or something like that. And so bets are September, October, right? That's pretty much it. And this is the thing. The Bank of England is building up pretty much the same kind of expectation, right? So September, October, and then after that, you've got your political, cultural influences, and you're not really going to have a rate rise leading up to Christmas. I wouldn't expect that to happen. And if you remember early last year when the pound was being talked up, I said at that time, it would be really strange to have a rate rise before the general election. I couldn't see that happening either. And lo and behold, the closer we got to the election, by the end of 2014, it was the rate rise was off the cards until the end of 2015, right? So you have to take some of those factors into consideration, and that's just general timing and it's politics, right? So the GBP USD actually kind of reflects that. Okay, so she seems as happy going down as she does going up, right? And that's to do with, so if you're kind of looking at the highs and the lows on GBP USD, we've seen rallies in GBP NZD, GBP CAD, GBP AUD. What are you looking at here? Thousands of pips. That wave began 2,500 pips ago, right? So maybe a little bit overdue, a deep correction too, but it began 2,500 pips ago. Whereas if you're looking at the pound dollar, she's happy where she's at. She can go up and she can go down, and that generally has that thing about, I think you just got to wait and see who moves first. And even if the Fed does move before the Bank of England, the price would equally snap back. It seems as though there's some kind of an equilibrium or some kind of a balance that the price has found at these levels. Although sub 150, we do believe that the Bank of England believes that the pound is undervalued. Sub 150s So the pair itself seems to be demonstrating more equilibrium than anything else, and that's why you have to be careful with your trigger conditions on the pound dollar itself. Hey, anyone remember what happened to NZD-JPY? So NZD-JPY was our last big trade call when I was here a few months back. Yeah, boom. Right. So I think the last time I was here, we were looking at this and calling that a double top, and the price was here in this range. And there was this thing about don't be surprised if we come back in a few months and she's in the lower 80s, headed into the 70s. Quite a substantial correction there now on NZD-JPY. All right, so um, quite a quite a big move there, and so now she's free to rally too. Headed straight into a kind of support block. She's free to rally, or certainly she could hold her own inside of this range. And all of that kind of it's all around that analysis on expectations for the NZD USD. Okay, guys, that is my lot this morning. I've overrun a little bit, but thanks for staying the course with me. I hope you've enjoyed the presentation. If you like to hear more of my analysis, don't forget to check out my website. It's wmdforex.com. I publish my analysis on there every week. We also have arrangements if you would like free access to my analysis. Just drop me an email from the website and I'll send you details how you can get yourself a free subscription. It's usually worth about £480 a year, but we could come to some kind of an arrangement on that. All right, folks, I'll see you all again in a couple of weeks' time back here on FX Street. Cheers. Thank you. Bye-bye.